In this video, I'm going to continue the discussion on dilutive securities, and more specifically, we're going to discuss stock warrants and the accounting for it. So, to reiterate, these dilutive securities that we're referring to are not common stock in form, but they enable holders to obtain common stock upon the conversion, like we saw in the video on convertible bonds and convertible preferred stock. So upon conversion, you can get common stock, right? Or upon exercising in the case of options and warrants. So don't let all this, it seems like there's notes everywhere here. Let's not let that overwhelm us here. Two things that I'm discussing in this particular video are warrants and stock rights. Okay, so those are the ones where you exercise the option to buy stock. And at the end of the day, it doesn't matter what we call these. I think we get, there's a lot of different ways of discussing this where you can convert, you can exercise. It doesn't matter. At the end of the day, all of these at the end of the day are just an option that you have to be able to acquire common stock, right? So whether we call it a convertible bond or a convertible preferred stock, at the end of the day, it's an option that you have later on to convert those bonds to stock. Or in the case of warrants or options, you have that option to exercise and purchase that, right? So we talked about why we call these dilutive securities, and it's because obviously the more common stock that you have outstanding, the lower the earnings per share is, right? And possibly the dilution of the owner's percentage occurs, right? So there'll be a video that's on earnings per share and how to compute earnings per share given these dilutive instruments. But let's focus here on this part in this video. Let's focus on the options of the warrants that can be exercised. Now, if you have a warrant, a stock warrant, it gives the holder the option to purchase common stock, and this is important, at a specified price and at a specified time period. So these two things are very clearly stated. And it's very different from convertible instruments like convertible bonds and preferred stock in the sense that when you exercise one of these, when you exercise a warrant, okay, when you exercise one of these options, there's going to be money exchanged. The holder of that warrant will have to pay for that stock. Now, it doesn't mean that they have to pay it at the market price. They pay it at the exercise price dictated on that warrant or option. That's a big thing. So when we convert bonds and preferred stock, there's usually no exchange of cash going on, right? Because we use the book value method. Now, if you recall, this is the video on convertible bonds and preferred stock. When you convert, you simply convert the bonds to common stock, but there's no cash being exchanged. Same thing with convertible preferred stock. So if you want to refresh yourself on that video, go ahead and watch that. Now, in the case of warrants, which is what we're discussing here, there is going to be an exchange of cash. All right, so let's look at two examples here. Let's look at the first one here on warrants. And in this discussion, I'm going to assume that these are detachable warrants. And what I mean by that is, if you recall, when we did the convertible bonds and preferred stock, those warrants or that option to convert to stock was ingrained or part of the bond itself. You could not detach it and sell it separately. So with options and warrants, usually the idea is that those things are detachable and you can actually trade them separately from the bond. If it's the bond, like in this example, but it could be any instrument that has them. Okay, so let me give you. So because they're detachable, we account for them separately. And I have a little note here. It says if non-detachable, if the warrant that you have or the option that you have is non-detachable, then it just follows the same rules of convertible bonds and preferred stock. So that's why I say here, see that video on dilutive securities, convertible bonds, and this should be preferred stock, sorry, and preferred stock. Okay, but what I do want to show you is that even though this is the information on the convertible bonds and the preferred stock, even though these bonds came with a conversion option, notice how we never accounted for that conversion within the transaction date on the date of issuance. It was just part of the bond, okay? Whereas now we're saying, since this is a detachable component, then I can account for it separately. Since it's a detachable component, then I'm going to account for it separately. So let me give you an example. We have a bond payable that is issued. So we issued 1,000 bonds. Company issues 1,000 bonds at $500 face value. And each bond has one warrant, one detachable warrant. Let's be very clear about that. That gives the holder and the ability to buy stock at $15. And this stock has a par value of 5. That's just information we'll need. But the important thing is that if you have these warrants, you can buy stock at 15 at some specified time. And we're going to ignore that information, but that would be critical, obviously, in the real transaction. When we sell these bonds with the warrants, the proceeds were $500,000. And if we were to value these things separately, then, you know, we would, if we had the ability to determine the worth, we determined that the fair market value of the bonds were $490,000, and the fair market value of those warrants was $25,000. So obviously, this year adds up to more than 500, right? So because that's the case, you could think of it as you offering or you selling this bond somewhat at a better deal than what it's worth. And if that's the case, then we have to account for it, right? So before we actually do the journal entries, we need to think about how we're going to allocate that $500,000 total, because those are the proceeds. That's the money that came in. So don't let this sidetrack you, but nevertheless, this is important to understand. So we could use a couple of valuation approaches. The first one is, and by the way, what am I trying to do here? I'm trying to determine, since I have detachable warrants, I'm trying to determine how much of this 500 will go to the bonds and how much will go to the warrants. Because now that I have detachable stock warrants, then I need to account for them separately. All right, so I could use the proportional method or the relative fair market value method. And this is the case where you know both fair market values, like in our case right here. You know the worth of those two things. So if I do know both, then I go in here and say, okay, the fair market value of each, the bond and the warrant, is as follows. That gives me a total of 515. Now, I did not receive 515. I received 500. So I'm going to have to allocate that 500 based on these percentages. So the relative fair market value is 490 out of 515 is 95% roughly, and 25 out of 515 is 5% roughly. So when I allocate this without rounding, then I get out of the total 500,000. Notice my formula here. I'm multiplying 500,000 times whatever this proportion is, which we said it's like 95%, and that gives me 475,000 roughly. And then the amount for the warrants is going to be 24,000 roughly. Now notice how by doing this proportional method, I'm allocating the 500,000 that we have in proceeds. And that's what this 500 is for here. Okay, so now that I have the approach, one approach done, then I can go and do the accounting. Now on a side note here, there's also a different approach you can use, which is the incremental method. And this one is the one you use when you know the fair market value of one of the instruments. So just as an example, let's say that I know that the warrants are worth $27,000. Well, by default, if I received $500,000 and I know these things are worth $27,000, then I know that my bear with me here. Let me put red on this so we can be consistent. Then I know that my bonds are going to be $473,000, or the difference. No crazy math here, okay? This is just straightforward. But for our purposes, since we knew both fair market values, we're going to use the proportional value method, which means that the warrants, I'm going to assign 24,272 to the warrants. And the way that would look is as follows. if I'm, by the way, if I'm assigning 475 to the bonds, and these are $500,000 face value bonds, right, in total, then I must have sold it at a discount, right? It's the way we're going to account for it. So the value of the warrants right here, 24,272, and then the value of the bond right here, the bond payable of 500 minus its discount of 24,272 gives me the valuation I need so that this journal entry accounts for the $500 of proceeds. Okay, and again, let me color this in red so that we are consistent in understanding that that 500,000 is what we receive. Okay, so then later on, we exercise, or the holder exercises these warrants, right? And you value the transaction at the exercise price. So recall that this particular warrant allows the holder to exercise it at $15. So that means that whoever exercises it is going to pay $15 for each share. Now, let's just assume that everything was exercised to keep it simple. That means 1,000 shares were exercised at $15 each, so the company receives $15,000 upon exercising, right? And then you remove the warrant. Here's the debit for the removal. And then you credit common stock for its par value. So it's 1,000 shares times the par value of 5 that I told you here. So that's 5,000. And then the remaining goes to additional paid-in capital for the common stock. Now notice that the value of this transaction, the value of the exchange here is, or the value of what you record is at the exercise price. Because keep in mind, for somebody, the holder of this warrant to exercise this, it must mean that the stock is actually trading at more than $15, right? Otherwise, it would make no sense to exercise that option or that warrant if it's trading cheaper in the market. So this would be exercised in the case where the stock is trading at more than the strike price or the exercise price. And we would say that that option or that warrant is in the money because there's a gain to be had there if somebody exercises it. Okay, so the other option is if this warrant or option is not in the money, it's not trading where we would be able to have a gain, or the holder would have a gain. In other words, the stock is trading at less than $15. If it's trading at $15, why would anybody exercise an option here to buy it at $15? They could just go out in the market and buy it for less than $15. So if that happens, most likely these warrants will expire. So if they expire, that's why I have an or here. You either exercise them or they expire. So if they expire, then you just reverse out the credit here for the warrant, and then you put it into a PIK and an account called expired warrant. All right. So the reason you do that, and this seems like a real weird reversal because you're removing an equity account to now put in another equity account. The reason you do that is because at some time when you sold that, okay, those warrants had a value and that cash came in. So now what we're saying, and if they would have been exercised, then that equity would have belonged to some stockholders out there. But if it's not exercised, then that equity technically is the company's equity, not somebody else's. I know that's a weird way to think about it, but at least that's the way I think about it, right? Since it was not exercised, but we did receive value for them in the past, then it's our equity. It's the company's equity, and it's not a stockholder. All right, so that's how you account for warrants that are detachable. The main idea here is that you assign a value to them, okay? Unlike what you did with convertible bonds and preferred stock, where because they were non-detachable, you would not assign a separate value for the warrants, right? Here we are doing that. All right, and another one, less, one that is maybe perhaps less obvious, is the idea of stock rights. Okay, this is based on the preemptive right that existing stockholders have. So in other words, if you own 10% of a company, and then later on that company issues more shares to raise funds, then you have the preemptive right to be able to purchase enough shares so that you can maintain your 10%. So when a company is going to issue stock, they give existing stockholders these rights that are of a short-term duration that a stockholder can use to purchase more shares. And many times they are at a favorable price, so they may be offered, but that's not always the case. But nevertheless, here's what happens. When they are issued, okay, so they give these stock rights to existing stockholders, there's no journal entry done, okay, because at this point there is no exchange of cash like occurred here with the sale of the bond. So it's just a memo that we note in terms of who was issued a stock right or the warrant to be able to purchase more shares. If they exercise, again, valued at that exercise price, just like the issuance of any common stock, you debit your cash for the amounts of X and Y here, X and Y being common stock and additional paid-in capital. So that's just a regular journal entry for issuing stock, except that you got to value it at the exercise price, not at the market price, because the market price, again, is probably going to be higher, right? All right. And then if they are not exercised, okay, then we have no journal entry. If they expire, we have no journal entry because, keep in mind, no journal entry occurred at the beginning. Whereas here, this journal entry gave rise to this warrant that later on we have to remove. This gave rise to nothing. So we are just going to do nothing if they expire. All right. So to conclude, let's just be very clear here. This is the second video of dilutive securities. And I'm going to have a third video where I talk about stock options as a form of compensation. Okay. They also can dilute the earnings per share because of the fact that if it exercised, then obviously there's more shares out there, right? But that's stock compensation. That's going to be compensation in the form of stock options. That'll be another video. But technically, it follows the same idea here that we're describing with the warrants. All right, this concludes the video on dilutive securities and more specifically stock warrants.